On March 9th, 2023, a bank lost $42 billion in a single day. Not over a bad quarter, not over a bad year. It was just one single day. It was the fastest bank run in American history, and by the next morning, the bank was gone. Here's the part that gets me. It wasn't a run on the bank in the way you're picturing. Nobody was lining up outside a branch with a suitcase. This bank died because of tweets. Let me walk you through what actually happened, because I promise it's not what you think. The bank was called Silicon Valley Bank, or SVB. If you've never heard of it, that's kind of the point. It wasn't a bank for regular people. It was the bank for tech startups. Roughly half of all venture-backed startups in America banked there. If you've used an app built by a small startup in the last 10 years, there's a decent chance SVB was holding that company's cash. So here is what happened, and where it all went wrong. When SVB took in all that startup cash during the boom years, they didn't just sit on it. They invested a lot of it in long-term government bonds. Totally safe investments, the kind your grandparents would approve of. But bonds have one weird property. When interest rates go up, the market value of older bonds goes down. And starting in 2022, the Federal Reserve raised interest rates aggressively to fight against inflation. So SVB was quietly sitting on billions of dollars in paper losses. Not because they did anything reckless, just because of how interest rates moved. For months, almost nobody noticed. It was invisible. Then, on March 8th, 2023, SVB tried to do the responsible thing. They announced they'd sold a chunk of those bonds at a loss, about $1.8 billion, and they needed to raise more capital to shore things up. In a normal world, this is a company being transparent and proactive. In this world, it lit a fuse. This is now where we saw the power of Twitter and the effect it could have on businesses, no matter how big they are or what their reputation is. Because SVB's customers weren't regular depositors. They were startup founders and venture capitalists, one of the most online, most connected industries on Earth. Within hours, prominent VCs were posting all over Twitter, destroying what was left of Silicon Valley's reputation. Founders were forwarding those tweets into private Slack channels. Group chats that normally shared memes were now sharing screenshots of SVB's balance sheet. And here's what made this different from every bank run in history. These founders didn't need to drive anywhere, queue up, or speak to a single human being. They just pulled out their phones, opened an app, and moved millions of dollars with their thumb. No lines, no tellers, no time to think twice. The money was just gone, one tap at a time. So you had the fastest spreading rumor in the history of banking, combined with the fastest possible way to act on it. That combination had never existed before. On March 9th, the panic hit full speed. Customers pulled $42 billion out of SVB in a single day. To put that in perspective, that's more than the entire market value of companies like Levi's or Hasbro, gone from one bank's accounts in under 24 hours. By the end of the day, SVB had a negative cash balance of about $1 billion. They didn't have the money to cover what people were asking for. Regulators shut the bank down the next morning. March 10th, 2 days. That's the entire arc from "we're raising some capital, don't worry, late" to "this bank no longer exists." The head of the House Financial Services Committee later called it the first Twitter-fueled bank run in history. And economists who studied it afterward found something even more unsettling. The panic didn't just stay contained to SVB banks that had a lot of Twitter chatter about them in the weeks before, saw bigger stock drops too. Even if their situation was completely different, the panic itself became contagious, independent of the actual financial risk. Regulators ended up stepping in over that weekend, guaranteeing all deposits at SVB, even the ones above the normal insurance limit, specifically to stop this kind of panic from jumping to other banks. Here's what I keep coming back to. Bank runs aren't new. They've happened for centuries, but they used to take weeks. People had to hear a rumor, decide it was serious, physically go to their bank, and stand in line. That built in a natural delay, time for cooler heads, time for regulators to react, time for the rumor to maybe turn out to be wrong. SVB didn't get that delay. The rumor and the ability to act on it moved at the exact same speed. Instant. A newsletter flagged a risk. VCs amplified it on Twitter. Founders acted on it from their phones in real time. There was no gap left for anyone to catch their breath. And this is the part that should sit with you, even if you've never opened a business bank account in your life. The systems we all trust, banks, institutions, anything built on confidence, were designed for a world where panic spread at walking pace. We don't live in that world anymore. Information now moves as fast as the tap of a thumb, and apparently so does $42 billion. SVB was the first bank to die this way. Given how we all communicate now, it's very unlikely to be the last.